No matter your age, your plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. I've ran across some interesting articles here in the past, about week, 2 weeks now. One of the things that I'm running into, it has to do with Social Security. The Social Security Administration, the trustees report came out recently, and one of the things we're seeing in there is how the numbers have started to change. In other words, we're seeing things getting kind of worse instead of better when it comes to our Social Security trust, I shouldn't even say trust fund, that's kind of a misnomer. Even though it's referred to as that, in reality what we know is this, is that Social Security Administration, when it comes to how the monies that go out to pay Social Security benefits and of course Medicare, these come from payroll taxes. So the payroll taxes that we pay in are used to then pay out the Social Security benefits to the recipients that are retired now. Now, one of the things that goes with that, also there's taxation for some, for many in fact, there's taxation of those Social Security benefits, and that also helps in regard to paying out these benefits. Well, guess what? For the first time this year, what we're seeing is that we're actually in the red. The Social Security Administration is now paying out more than they're taking in. So they're in a negative territory. And this is where this trust fund part comes in, all right? Now, in reality, there's not a pool of money sitting somewhere that's been invested, let's say, right? There's no portfolio that they're going to be pulling from that they've got earnings on. No, no, no. What this is a file cabinet full of IOUs, of Treasury notes, that our Congress has issued back. They've taken this money, they've used it up over the years, and they've basically, in essence, in these notes are nothing more than IOUs. This is the Congress saying, okay, when you run out of money or you can't pay those benefits, you can cash these in. You can come to us and we will then give you the money to pay the benefits that you're short. Now, where does that money come from? Right? Like I said, it's not a pool of money that's actually invested. That's where this misnomer of calling it a trust fund would indicate that that was the case, that there was actually a pool of money. In reality, what we have, of course, is it's going to be coming from income taxes. So it's going to come from the general funds. So what does that mean for us? Well, if we're not paying it in payroll taxes, we're paying it in income taxes. We are now at historically low income tax rates. In particular, with the new tax law now, we have some of the lowest rates we've seen in a history of income taxes. Now, one of the things, in fact, if you make $50,000 a year, for instance, you're in a 12% income tax bracket. If you go back last year, you would have been in a 15% income tax bracket. So think about that. What we've seen basically is a 20% decrease in our tax rate, okay, for those making $50,000. All right, and for a couple, that means $100,000, by the way. Now, what if we go back, let's say to, we'll go back, say 15, I think it's about 15, 16 years before the last Tax Act, then you would have been in a 28% bracket. You would have been paying more than double what the tax rate is today, making $50,000 a year. And if you go back another 20 years, guess what? It would have tripled. It had been 49% tax rate. So we're at historically low tax rates. This is something to keep in mind as well when we think, now let's go back to that conversation, right, about Social Security. So we got more boomers and more people that are going to be joining those receiving Social Security. In fact, here's some statistics for you. There are 74 million baby boomers born between 1946 and 1964. Every one of them will be over the age of 65 by 2029, so in about 10 years. So we're seeing already this increase. We've got currently about 62 million approximately people receiving Social Security currently. So think about that. That means adding another 10 million people to receiving Social Security, and we're just saying that they're not taking in enough now to pay out what they need to pay. How are they going to fix that system? Well, what's one of the fixes that we've seen? It's payroll taxes. Might they raise those? That's possible, right? People paying in. Now, here's the other part. If we've got more people retiring and fewer people coming into the workforce, that means fewer workers paying for those that are retiring. That creates a bit of a dilemma as well, doesn't it? So one of the things that we know is that Social Security benefits, depending on your income, can be taxable. Up to 85% of what you make from Social Security could be counted as taxable income added to other taxable income, and then of course whatever tax bracket you're in as to what you're going to pay. So what does that look like? What it means then is that where are they going to get this money? right? Where are they going to get the money to pay the benefits? They're in the red right now. Historically low tax rates. Payroll taxes, we just said, right? We're going to have fewer people paying in. So maybe they can raise those, but still fewer people paying in. It's still not going to be enough. So what are they going to raise income taxes, wouldn't you think? Do you expect that your income taxes are going to go up? So if you do, how does that affect your planning? And here's something to think when it comes to investing. And I'm going to talk a lot about investing today, about how you're going to prepare. So if you're going to be paying higher taxes, right, again, it's not just what you make, it's what you keep. So we want to have strategies to help when it comes to investing, as an example, tax efficient strategies with our portfolios to minimize the effect of taxes. Other things that we can do, if we're at historically low tax rates today, as I said, a $50,000 a year for a single, that's 12%. You're still in a 12% bracket. If you're making $100,000 as a married couple, again, still in a 12%. Only 12%. Again, just think of how low this is historically. As I just mentioned, just a year ago, 15. You go out another 15 years approximately, and you're at 28%. Another 20 at 49. So there's a lot of room, right, for income taxes to potentially go up. And when we look at this type of issue alone, just this one, not counting all the other things with regard to deficits and that, but just on that Social Security, we see that at least they're going to have to make some changes there, and most likely that means getting more tax money in to help pay for those benefits. So how can you protect yourself? Are there some things, for instance, it goes to what is taxable income? Can you change what you're receiving from Social Security? Yeah, you know, waiting gives you a bigger amount, but when it comes to receiving those benefits, that's not, when it comes to taxation of those benefits, you know, there's not much you can do with the exception of this, right? What if, let's think about this. If you've got IRAs, if you've got 401ks, you've got money in retirement accounts that you have not paid tax on yet, all right, and you continue to add to those to defer your taxes, well, if you're in a 12% bracket, and this isn't going to push you into the next bracket, which is, by the way, 22%, almost double. So if you can stay in that 12% bracket, would you be better to pay the tax today rather than pay it in the future? Would it be, in fact, in your best interest to maybe go ahead and pay that tax so that, and maybe instead of putting that money into a traditional 401k or IRA, maybe we go with a 401k or IRA that is a Roth? Okay, a Roth 401k or a Roth IRA. Might that be better, because those monies are going to grow tax, they're going to still grow tax deferred, you're not going to have to pay any tax on it. And as long as it's in there for 5 years, you're going to have tax-free income from it when you take money out. So instead of having taxable income, because here's the other part of that. Every week when I'm sitting down with new clients and we're going over their finances, one of the things we're looking at is the effect that required minimum distributions when they reach age 70 and a half are going to have on them when they start taking income out. And it doesn't necessarily have to even wait until 70 and a half. It could happen sooner, right? And most likely does. When you retire, where are you going to get the money you need to supplement your income? Because Social Security is not going to be enough, is it? Where are you going to get the money you need to supplement your income to be able to attain and maintain your standard of living and your quality of life? Of course, it's for that money we've been saving. That's where it's going to be. Because now some may have a pension, and bless on you, but even there, I've got many clients that have Social Security and pensions, and guess what? They still need money from their 401ks and that to supplement that income. Because most pensions and Social Security alone, if you combine them, they're usually only going to be about 50 to 60% of what you were making when you were working. Okay, so that's not, you're not going to be able to live all of a sudden on half, right? So how are we going to make up that difference? And that's our retirement savings. And then how can we minimize taxes? Well, one of the things to be thinking about is, might I be better off to pay the tax today when I'm at historically low tax rates, since I'm pretty sure taxes are going to go up, and when I retire, and they're certainly not, they're very, we say at the very least, they're not likely to go down any further. Right? So that being the case, why don't I go ahead and pay that tax today with the knowledge that I'm not going to have to pay taxes in the future when I take that money out? Because here's the other part. That when I start taking those required minimum distributions, or when I start taking money out of my retirement accounts, what's going to happen? That's taxable income. That gets added to my other income. Well, here's where that Social Security piece comes in. There's something called the provisional income formula, and this can cause, depending on how much income I have, it can cause my Social Security benefits to be taxed. So all of a sudden, let's say I'm making on Social Security combined for a married couple, let's say age 65 and above, and let's say that we look at that and it's maybe 40, maybe 50,000 a year or more. So if, let's say you're getting $40,000 a year from your Social Security benefits. And guess what? You get a required minimum distribution, and let's say that's maybe $30,000 a year. Now all of a sudden, and it doesn't have to be that high, it could be, you know, 10 or 20,000 even a year would create this situation potentially. So the provisional income formula, we're adding Social Security, we're adding other income. If we have a pension, we've got to add that in. If we have investment income of some sort, rental income, whatever it might be, and then of course those require minimum distributions. So if I've got 20,000 required distributions and I'm making 45,000 on my Social Security, guess what? All of a sudden I'm going to have to pay tax on up to 85% of those Social Security benefits, which shy of having that income coming in, I would not have to pay tax on. Now if I have 40,000 again, we'll say that 85% of that becomes taxable. All right, all of a sudden I just added $34,000 of taxable income that wasn't maybe there before. Okay, and depending again, now if I'm in that 12% bracket, you know, there's, you know, I'm just paying basically about, what is that, about $4,000 tax on that. All right, so I've just created $4,000 in taxable income or taxable tax outlay that I'm going to have to pay just because of the amount of income I make in addition to Social Security. So this is something to keep in mind. Now what if I take that same scenario, okay, and instead I have Roth income, money coming out of a Roth IRA, which is tax-free, which does not count. All right, now that Social Security benefits are not taxed at all. So I just went from paying $4,000 tax there, and let's say again we go back to that $20,000 number. So if I pay $4,000 on my Social Security benefits, plus I'm paying on that the income on my RMDs, I'm paying tax on that. If I eliminate that by making it a Roth, tax-free income, now there goes $4,000 I just saved in taxes right away. $4,000 that I get to keep each and every year by a Roth strategy versus that. And that's at a low end. If I start, you know, the higher my income, the bigger that benefit may be. I could easily be double that. Could be $6,000, $8,000 a year in tax savings each and every year. Something to consider when you're looking at where you're at today. When we're talking about investing for retirement, when we're talking about putting money into those IRAs and into your 401ks, one of the things to look at is what's your tax bracket today? How much are you really saving, and does that make sense compared to what the future may hold? Well, we're going to get into more, and we're going to talk more about investing, not just about the tax benefits or tax parts of investing, but also how to make more on your money. And how much money, in fact, do you really need? How much do you want to make on your money? You know, and how does that work? What's the balance between risk and reward here? We'll get into that and more. Join me here. We'll be right back on the Retirement Report.